Welcome to our exploration of the intricate world of central banking, a pivotal force in global economics. Today, we begin by setting the stage with an overview of central banks around the world, understanding their roles and how they interconnect in the international financial system. Central banks, from the European Central Bank to the Bank of Japan, each play a critical role in their respective nations by managing monetary policy, controlling inflation, and stabilizing their currencies. Among these powerful entities sits the Federal Reserve, the Central Bank of the United States. Unlike many believe, the Federal Reserve operates independently of the U.S. government. It was established in 1913 on the private grounds of Jekyll Island by notable figures, including J.P. Morgan. This unique origin story highlights its position not just as a governmental tool, but as a private institution influenced by wealthy elites. This episode will delve into how this private club impacts the U.S. economy and contributes to the broader discussion of economic disparity. Stay tuned as we uncover the Federal Reserve's historical impact in the next scene. Welcome to our in-depth exploration of the Federal Reserve's role in economic disparity. Today, we scrutinize how this central banking system of the United States influences financial inequality, particularly among younger generations. The Federal Reserve, known for its significant control over the nation's monetary policy, has a history filled with contentious decisions. Historical criticisms pinpoint the Fed's policies as catalysts for major economic downturns, including the Great Depression and the 2007 to 2009 financial crisis. These events have had long-lasting effects on the job market and financial stability for millions, especially impacting millennials as they entered the job market during these turbulent times. Turning our focus to the gold market, the Federal Reserve's involvement is undeniable. The United States holds the largest gold reserves in the world, a fact highlighted by Investopedia. While initially backing currency, today these reserves serve as a buffer against economic uncertainty. The Federal Reserve Bank of New York houses a significant portion of this gold, reflecting the Fed's powerful position in global finance. However, the manipulation of gold prices by central banks, including the Federal Reserve, as reported by American Bullion, has broader implications. It affects the value of the dollar, and consequently the economic environment that young adults face today. High gold prices can exacerbate the cost of living, adding to the financial burdens of an already struggling demographic. Economic disparities are further magnified by current Federal Reserve policies. According to Pew Research Center, millennials earn significantly less than previous generations when adjusted for inflation, and the cost of housing has skyrocketed to 7 times their earnings. The Fed's interest rate decisions directly influence these economic conditions, affecting everything from mortgage rates to savings returns. Critics like economist Terry Burnham, cited in a PBS article, argue for the dissolution of the Federal Reserve due to its history of monetary missteps. These criticisms underscore the profound and often controversial impact the Fed has on economic disparity and financial stability. Let's delve into potential alternatives to the Federal Reserve system. One intriguing possibility is the role the U.S. Treasury Department could play in managing the nation's finances, should the Federal Reserve be abolished. Historically, the Treasury has already been involved in issuing currency and managing government accounts, but without the Federal Reserve, its role would expand significantly. This would include more direct control over monetary policies, such as interest rates and inflation targets, potentially leading to a more transparent and accountable financial system. However, the transition away from a central bank system would not be without its challenges. Economists debate whether the Treasury could effectively handle the complexities of modern financial markets, where rapid responses to global economic shifts are crucial. There's also the risk of increased political influence over monetary policies, which could lead to decisions that favor short-term political gains over long-term economic stability. Looking globally, there are few modern economies without a central bank, but studying those that function differently provides valuable insights. For example, the Principality of Monaco, which uses the euro without its own central bank, relies heavily on the monetary policy set by the European Central Bank. This arrangement offers both benefits and limitations, showing that while possible, a no central bank scenario requires careful consideration of economic sovereignty and stability. Understanding these alternatives helps us envision different economic futures. As we ponder the possibilities, it's crucial to weigh the pros and cons of such significant changes to our financial system. As we continue to monitor the Federal Reserve's actions, it's crucial to understand their far-reaching consequences. The links in the description below provide further details from sources like Investopedia, PBS, American Bullion, CBS News, and Pew Research Center. We encourage you to visit these links for comprehensive articles and their illustrations. Support our channel by making your everyday purchases through the promotional links in the description, accessed via American Northwest Products website. Like, subscribe, share, click on the notification bell, and we welcome your comments. Your engagement helps us continue providing valuable content.